Okay, can everybody see my screen? Okay, the class have started. I want to believe everybody can see my screen.
Yes, okay.
Okay, so let's mute our mic now. Okay, let's start. Today we'll be starting with when to trade forex. When to trade forex. That's what we'll be starting with. So really, when do you trade FX? Let's start. So the first thing we're going to talk about is spread. Now, what is spread? Spread is the difference in price between buying and selling the base currency. If you look at my chart, there is this 1.4 pip spread. That's the difference between this number, euro price, and the USD price. If you minus this, you will get 1.4 pips, 1.4 pip spread. Now, the way may I explain or I see spread is, for example, if you go to all this Aboki, all this smaller to exchange dollar, you see that commission they charge you for. That commission they charge you for is what I call spread. Yeah, that's what I call spread. So your broker, the broker you'll be using to trade, they will charge you what we call spread. Okay, they will charge you spread, and you have to know spread now and importance in your trading success or in your profitability. So that's spread for you, the difference between the buying and selling base currency. Don't worry, as you continue, you get to know more of these technologies. So volatility. So volatility is when a condition in the market begins to change rapidly. If you look at my picture here, you will see this jaga 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 jaga. This large movement is what we call volatility. Okay, we have the high volatility and we have the low volatility. In the high volatility, this is here. The high volatility, sorry, big moves take place. Okay, that's so in high volatility, we expect the market to move rapidly, to move widely. Big moves take place. The major news release. Traders are happy for this. Okay, when you have high volatility in the market, that's the best time to enter a trade. That's a good time for you to be profitable. So definitely we will be happy. Okay. In low volatility, the market is sluggish. What you'll be having is just back and forth consolidation. I will show you in the chart what consolidation is. So market will be sluggish in both low volatility, and there is no major news release. And this is the trader's nightmare. You do not want to be caught in a consolidation market. Later on, you know what consolidation is. You do not want to be caught in it because market will be going up. So okay, yeah, market is going up, you buy. The market starts selling, they say, oh, market is selling, you sell. So it's really plays with the trader's mind, especially newbies. So you do not want to trade in a low volatility market. So that's volatility for you. The next one is liquidity. Liquidity is what I call it where the money is, because my trading system calls it that. ICT, they call it where the money is. What I mean is liquidity is basically the amount of orders that are placed by participants or by traders. The amount of orders that are placed by traders in a particular place. Okay, the amount of orders that are placed by traders in a particular place. I'm going to show you that in a chart very soon. So these are the four main Forex sessions. We have the Sydney, the Tokyo, the London, and the New York. Now let's start with the Sydney section. This is where the trading officially starts. It's the Sydney session, and it's the smallest and calmest of the mega markets. So the pairs that are more active in the Sydney sessions are the Australian dollar, that's AUD, and the New Zealand dollar, that's NZD. So you get high volumes, or high volumes of these pairs. These pairs will be mostly traded around that time. So the AUD and NZD, you expect them to move well, expect them to move rapidly. You expect more volatility in the Sydney session with these pairs. Okay, it's an Australian market, and it is slow market, and it happened 9 p.m. to 6 a.m. GMT. The next one is the Tokyo session. It's the second session. It's the second session after the Sydney, and it's the third largest forex trading session in the world. So the pair that is mostly traded in this Tokyo session is the JPY. Okay, and it occupies 6% of the forex transaction. Okay, so if we merge Tokyo and Sydney session together to be called an Asian section. So we call Sydney and Tokyo Asian session, and it's a low volatility session. Okay, I do not advise anybody to trade anyone in this mentorship to trade Tokyo or Sydney session because they're low liquidity. You will not see a lot of traders trading at this time. So, and if you don't have much volume or liquidity in the market will be consolidating. Well, based on this trading system, I will teach you when to trade actually. And in this presentation, you also find out, okay? And this is 11 p.m. to 8 a.m. GMT. All these times are for retail traders. I will tell you the real time for you to trade as an institutional trader, okay? Learner session, the third trading session. The pairs that will be mostly traded at this time are the GDP, that's Great Britain pound, and euro, and the Swiss franc, that's CHF. And they are widely traded session globally. About 35% of the forex transaction is happening in the London session. So this kind of session is what I like to get myself into, okay, because of the amount of liquidity or volume, and it's very active session. And we use the major news releases around this time, and we use Techno L9. You're raising your hand. Don't worry, when we are done with the class, you ask your question. I believe it's a question. So in so there are major news releases in the London session, and it starts 8 a.m. to 5 p.m. GMT. Forget those times. I'm going to give you the real time. The New York session. This marks the end of the Forex day. So by New York session, most traders are already done with their profit or their loss, and they are back to their house. Because market will go back into Sydney once again, and the cycle continues. So 85% of the trades involve the USD, that's the United States dollar. So you want to get yourself into this kind of session, okay? The USD and Canadian move the most. There's high volatility. Major news releases occur around start of the New York session, 8 a.m. to 5 p.m. GMT. So really, what is the best time to trade? Because I was talking about you forgetting those time I put there. I was saying that retail timing. So I want to give you the institutional time, and this is what we call the IPTA true day. We're going to get to the IPTA true day in the advanced class, but for now, get this time into your head. This is the knowledge I want to pass to you, because very few people know this timing I'm giving you. Okay, a lot of people do not know it. Even I have a lot of traders that don't know this time exists. But when I take you to the chart in the advanced class, you will see that this time are very accurate and it works wonders. So the London Q zone. I don't call this London session. There's a London session and the London Q zone. London Q zone is a part of the London session we focus on as institutional traders. We focus on a part of that London session. That's what we call the Q zone. Okay, like the name says, Q, 1 kilo. So the Q zone, yeah. So it starts 1 a.m. to 5 a.m. New York time. That's 5 a.m. to 10 a.m. Nigeria time. Okay, somebody saying, so I'll be waking up 5 a.m. to trade in the morning in Nigeria. Okay, how about somebody in New York? What would that person do? That person is waking up 1 a.m. to trade. And it's not like your trade will always, what's it called? It's not like your trade will always come around at 5. But this is the range you want to look into to get your trade. Okay, this is the time range 5 to 10 to get your London Q zone to trade at that time. Okay, and there's the New York Q zone, 7 a.m. to 10 a.m. New York time, which is 11 to 2 a.m. Nigeria time. So You want to start trading from 5 a.m. Nigeria time to 2 p.m. Nigeria time. Anything out of 5 a.m. to 2 p.m., I do not agree and I do not know what you're trading. Okay, this is what my mentor taught me. The owner of this trading system, that's what he taught us, and that's what he's using. So if you trade before 5 a.m. Nigeria time, you're on your own. And if you trade after 2 p.m. Nigeria time, you're on your own. You get I this is that's why we say best time to trade. It's not like outside this time is not good, but good is better is not as good as best. Am I right? So there's good, better, best. So you want to have high accuracy and high probability in your trade. So you trade the best time. Okay. And the worst time to trade is the Asian session, which I'm going to show us. Um, After 2 p.m. New York time and major holidays. Like I said, after 2 p.m., I told you not to New York time, not to look for anything to trade again. Is it 2 p.m. New York time? Okay, yeah, that's the London Q zone. We'll get to that in the advanced class. And the major holidays like the the Christmas, New Year, Thanksgiving, all those holidays. The reason why you do not want to trade in all those times because the major participants are not trading at that time. They're all on break. That's the central banks, the speculators. Most of them are on break, so there will be no high volatility at that time. So you do not want to trade at that time. Okay, so you just want to avoid that. And when they take holiday, you take holiday. I said that in the last class we did. So let me take you to the chart. Now, this is why I say you should not trade Asian session. This is what I call the Asian Q zone. Sorry. Okay, so this is what I call the Asian Q zone. This yellow box you're seeing here. If you look at this box, you see that market is just chopping. It's just doing chop, 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 chop. It's not really doing anything um, wild. Okay, it's not even moving far. It's just low volatility. Look at this place too. Nothing much. This here too, nothing much here, nothing much. So I do not want to trade in this time. Okay. I want to trade in the London Q zone and the New York Q zone. We'll get there in the advanced class. I'm going to show you all that. Okay. So this is what I want to. I explained this. I said this in the main group that the market is to accumulate, manipulate, and distribute, or market is to um, induce, trap, and shift. So this is what I mean. Let me explain that. So if I say market is accumulating, what do I mean? It is accumulating order. Look at that. It takes people, you first take people to buy. This green candle is a buy. So when we're going to get there, you know what a buy candle is and all that. So it takes people to buy first, and then it took them to sell, and then it took them to buy again. So it's jamming retail traders together. It's jamming their head together. It's making them buy and sell, 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 buy and sell. So it's accumulating their orders here. So that's what we also call it induce. It's induce them here. See, look at that. Induce them here to sell. After that, it came back up. This week, it took everybody's stop loss out. So this is what we call manipulation or trap. Once it traps them or it manipulates them to go up, it also takes that stop loss out. We're going to get to stop loss and all those things too. So you get back to this video after those classes. Let's take it one step at the other. So it's going to manipulate them and then it will now sell off. So what it's doing here really is that it's playing with the minds of the retail traders and it's eating and taking their money away. Okay, so this was the mistake I was making when I was trading retail strategy. I was trading in the Asian session, not knowing they were jamming my orders. They were jamming me and they were looking for how to take my money out. Like this guy, he took out anybody that sold from this place now that press sell from here. That stop loss will be here. It will get there, take that stop loss out. That's loss of money. You've lost that money and then it will now sell. The same thing he did here. Jam them, took them up, then he now sold. Same thing he did here. Jam them, took them down, then he now bought. Okay, so we are going to get there. This is Asian Q zone. That's Asian Q zone. I'm going to teach you in the advanced class. So you do not want to trade around this time, but in the London and the New York Q zone. So let's get to our next class. Our next class will be the buy and sell. Because I mentioned something now. Some of you will be like, well, how is it buying? What do you mean by buy? All I'm saying here is just jaga jaga. How you buying? How you selling? Okay, so let's get to it now. So buy and sell. That's the bulls and the bears. So we call it bull, a bull market, or we call it bullish. The reason why we do that is, if you should look at this bull here, if bull want to attack you, how do they attack you? With their horn, and then they raise you up. Okay, so once market is going up, like the definition says, when you expect currency value to rise, you place a buy. Okay, when you expect value of the currency to rise, you place a buy. That's what you're seeing in this bull here. When bull want to fight you, or when it wants to attack you, what does it do? How does it do it? It takes its horn and it pushes you up. Okay, so it makes you to rise, right? I think that's where they got the buy from. So they use a bull to represent a buy market, and it's called bullish. Okay, or you call it long. I am going long. So once I say go long on Euro USD, what I'm saying is buy Euro USD. Okay, or when I say if Euro USD is in a bullish market, what I'm saying is that Euro USD is buying. Okay, bullish market. So let's get to sell. Now, we call sell a bear market or bearish. Why we call that bear is because if you look at the animal itself, once bear wants to fight you or attack you, all it does is presses you down. It presses you down. It does not do more than that to just choke you with its feet on the ground. So in the definition here, you see that the currency value, the way I was doing my hand, only if you guys can see me. So we expect the currency value to fall when you sell, okay? You expect a currency value to fall when you place a sell order. So we call it a bearish. We call it bearish market. Okay, we call sell bearish or short. Okay, we call it short. So when I say short USD JPY, what I'm saying is sell USD JPY. When I say USD JPY is in a bearish market, or when I say euro is in a bearish market, what I'm saying is that euro is selling. Okay, so like I said, when you want to sell, when you say you want to sell, you're expecting the currency value of the market to fall. Okay, that's when you sell. When you expect the currency value of the market to rise, that's when you buy. Now, another question might be going in your head: how do I know currency value is going to rise, or how do I know it's going to fall? Don't worry, we will get to that in our advanced class. I'll teach you when to buy and when to sell. But for now, know that we buy when we expect market to go up, and we sell when we expect market to come down. Okay? Next one. This is what happens when you place an order. So buyers in the market cause exchange rates. Buyers in the market cause exchange rate price to rise as demand increases for a currency. So the more you buy a currency pair, the more the demand increases. The demand of that pair increases. So the demand of that pair increases. It causes the currency to rise. Once everybody is buying, I bought, you bought, everybody is buying, the demand for that currency pair will increase. And therefore, it will rise. It will go up. So when you say, and also the reverse is for the case for selling. Okay, so when people are selling a currency pair or a currency, it causes the currency to fall. Okay, the demand is not so high, so it's going to fall for that currency pair. So let's go to the chart and see what I'm talking about. So let me highlight this. So let me highlight this. So I want you to look at this now. Look at this shaded area. So this is a bearish market. Okay, you can see the market, it was coming down from here. The market went up. Okay, market went up. That is a bullish. Sorry, pardon me. This is a bullish market. Market increased in value. It rise. Okay, so you say you go long here. So let's imagine you. So in this kind of scenario, what you want to do is do what? A buy. You want to buy. Okay, you're expecting this market to go up. So what will you do? You buy. So if you bought around this place, market will have rise up to this place. Okay, this is another bullish market here. This is another bullish market here. Can you see that? This is another bullish market here. Market went up, but this is another one here. This is a small one here. So market bought, it increased in value. GDP USD, that's the name of this pair. Look at it here. GDP USD. The next one again. Look at this small one here. Look at this small one here. I know you are seeing another one too here. This is it here. Look at this one too here. Okay. This is a very big one. This is money. You cut this one. This one. Come on. Okay. Gotcha. You can see how high. You can see how high this bought from here. It went long. So I went long on GDP USD. This is what I mean. So you want to place your buy from the at the tip. Okay, I'm going to teach you how to get that. So you do not want to place at the middle. You place your buy at the tip and you'll be in money. So when you buy and the market goes up, you're making money. Okay. When you buy here, the market goes up, you're making money. When you buy here, the market goes up, you're making money. Buy, it goes up, you're making money. Buy, it goes up, you're making money. Buy here, it goes up, you're making money. So that's how we make money here. So let me show you a bearish market. Let me change this color now. Let me change this color to orange or red. Oops, it's too much. Okay, let's do orange red. Okay, that's what happened here. The market went down, sold down, sold down. So this is a bearish market. It went down. So you want to sell from up here, from around here. You want to sell. So as market goes down, you are in money. You are making money. This happens on all time frame. This is a 1 hour time frame. Okay. Now another question: what do you mean by time frame? Don't worry, we'll get there step by step. Look at this sell here too. Look at another sell here. Okay. This is another sell. Sell, sell, sell. So when you expect market to drop or to fall in value, you sell. And you don't want to sell at the middle or at the top. Okay. So the more it falls, the more money you make. The more it falls, the more money you make. The more it falls, the more money you make. Now you'll be saying, well, wait, this thing is falling and it's going back up. How am I supposed to know when to just close my trade or get out of the market before it starts going up again? We will get there. Okay, we will get there. You can't do everything here. So look at this one too now. It fell from here to here. So you have called the, let's say you call the sell from here. You call this bearish movement from here, and it sold down to this place. You made money from here. Also, let's say you cut the sell from here to this place. You made money. Okay, we are running out of time. I think it's going to stop us anytime soon. So any question? I think we have 3 minutes. We have 3 minutes. So mute your mic. That's all for today. That's all for today. Just these 2 topics, and then we'll continue the next one on Monday, 6 p.m. So any question? You can unmute your mic. Any question? Unmute your mic. Unmute your mic. Anybody? Don't worry. If you do not understand some things, when you watch the recording again, you will understand. And you can always send me a message on my Telegram. So anybody, any question, anything at all? Okay, so I talked about liquidity. Let's quickly get to what I say about liquidity. So you see this place, the market sold, the market went down. So all the people that entered at this particular place, that's what we call liquidity. There's a lot of volume here. There are a lot of people that entered here. So we call this place liquidity. We also call this place liquidity. So at the top of all those cell, there is liquidity there. The amount of participants that entered at that place is much. There's also liquidity at this cell. So the buy to same thing, okay? The buy to same thing. There's liquidity under here. There's liquidity under here. There's liquidity under here. There's liquidity under here. The amount of participants that entered at a particular time, okay? That's liquidity. So what we will do in this trading system is we hunt this liquidity. We take people's stop loss out because that's what the algorithm actually does. So the trading system hunts liquidity, and that's what we do all through. We're going to talk about that in our class. So I believe there's no question. So,
hello.
All right, Wheezy.
Yeah. Please, you highlighted the bullish and the bearish.
Okay.
Now I want to ask you what about the red in between the bullish, and also what about the green in between the and the bearish? What are they doing there? I don't understand. Can you please expatiate a little bit on that?
Okay, the
Thank you.
market, when you say you are buying, the market does not just go up and just keep going up like that. There will always be, yes, there will always be retracement. There will always be pullback. There will always be a red candle in between. Like this one is just green, but you see all this week you're seeing here. We're going to get to car and Japanese candlestick. All this week you're seeing here, they're all sales. So the market sold at a point before it started going up again. So all these green candles you are seeing in between it is because of that's how the market works. It does not just go in one direction. If not, you will not be seeing liquidity. If not, you will not be making money. There are a lot of buyers and sellers in the market. So when you are selling, other people are buying. That's why you get red candle or green candle in between your bullish or your bearish market. This red
Okay, can we just say can we now say maybe both of them are testing their own strength together?
Yes, something like that. But that's a fundamental analysis. What we do is technical analysis. So we know,
Okay.
yes, we know that they like may buy and enter like buy this green candle enter here now. Like may buy and enter. We know say it go sell. So there's no shaking for us because we have confidence in our trading system and we know what we are doing. Okay, like here now, this red candle between here that was in between this green candle. If it's our trading system say we should buy, we will buy without fear. So we write this thing up without coming out of this trade. Okay. So this red candle just stay there for staying there sake. So people that sold there, they will lose money. Okay. That's why this red candle is there. They sold around this place. That's why this red candle is there. We know this market will buy, so we will bought. So we will bought. I mean, so that's just it. So there will always be red candle or green candle in between a trend. Do not fear. It's an all-time frame. If you know what you're doing, you'll always be in profit most of the time. Okay.
All right, thank you.
Any more questions? Anybody else? So in the absence of no question, we're going to end today's class. So if you have any question to ask later on, you can send me a DM. I'm going to answer them. Okay. And if you feel well, and before you come to meet me, so I expect you've watched this recording again. Okay. So I expect you watch this recording again before you come to my DM. So because this recording can actually answer some of your questions. So I don't want that to be another issue. So so thank you very much. Continue on Monday, same time, 6 p.m. Bye, everybody.